Marvell trades at $88 right now, down 20% year to date. Revenue just jumped 58% year over year, but the stock can't seem to hold a bid. What's going on? Now, everyone's talking about the NVIDIAs and AMDs like they own the future of AI. But here's the thing, Marvell, they're not competing with them. They're connecting them. If NVIDIA is the brain, Marvell, well, they're the nervous system, the invisible layer that keeps AI, data centers, and cloud infrastructure running. And that's exactly why I'm still paying attention. But here's what's weird. Data center revenue was up just 3% last quarter, a big red flag in a sector that's supposed to be on fire right now. Yet Marvell has now reported 3 straight profitable quarters under GAAP, no accounting tricks, no fluff. So how can a company post real profits, strong balance sheets, and $4 billion in current assets and still lose 20% of its value this year? Well, that disconnect between performance and price is the signal that I'm watching. Because when the market starts pricing it right, the early investors will already be there. Hey, what's up? My name is Rick Orford. I've been trading since 1999, and no, I'm not a financial advisor. It's a good thing. I break down the numbers so retail investors like us can make smarter, more confident decisions with our money. And stick around because in this video, I'm going to be breaking down whether Marvell's $2 billion quarter is the start of something big, or maybe it's the calm before another drop. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. And you all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by almost 6 times. Go to fool.com/Ricko to get your 10 stock picks right now. Marvell Technology is a semiconductor company that designs and develops high-performance chips and other related products for AI data centers, cloud computing enterprises, and more. It operates through 3 segments: data centers for AI accelerators and cloud computing products, enterprise networking for Ethernet switches and edge computing, and of course, carrier infrastructure for 5G and wireless connectivity. Now, when people talk about AI semiconductors, they're usually or almost always thinking or talking about NVIDIA or AMD. And that's exactly the problem. Some of their products include wireless and networking processors, Ethernet transceivers, Ethernet switches, storage and memory accelerators, and of course, hardware security processors. Think of it this way. NVIDIA and AMD are the heart and brains of data centers, right? While Marvell, they're the blood vessels, the nerves, the connective tissues that connect everything and make everything work together. In other words, without Marvell, the system doesn't flow. The AI brain can't talk to the limbs, right? And I think this is why some investors are sleeping on Marvell and similar companies. While they may not be as big as NVIDIA, their roles are still essential in the cloud and AI ecosystem. So while everyone else is chasing the next NVIDIA, I'm watching the company quietly powering the entire system. So let's have a look at the stock because that's probably why you're here, right? Now, the last time I talked about Marvell, it was trading around $92.50. Now it's dipped to $88. Marvell has a 60-month beta of 1.94, and that means the stock price has been almost twice as volatile as the market. So if the S&P moves 1%, Marvell could move almost 2% up or down. And that's some serious volatility. And this volatility shows how Marvell has been performing. I mean, it's down about 20% year to date, but up 6% over the last 52 weeks. Meanwhile, the stock has moved by an average of 17% each time it's released its financials in the last year. So every earnings day, it's been a roller coaster. And that's where traders either make bank or get burned. And it begs the question, is this a buying opportunity today, or will the hype die down? This was recently brought up in my Discord channel. So let's look at the financials to get a clearer picture. because what's under the hood is what really decides if a dip is a setup or a warning. Now, Marvell hasn't yet set a date for their Q3 financials yet. So let's have a closer look at their second quarter financials for fiscal 2026. Revenue grew 58% year over year to $2 billion, while diluted net income did a complete 180, growing 22 cents a share from a 22-cent loss last year. That's not just growth, that's a turnaround. But this may not sound like a big deal, but the second quarter results mean that the company has reported solid profitability for 3 consecutive quarters on a GAAP basis. And I love GAAP because it tells the whole truth. GAAP, or generally accepted accounting principles, is the accounting standard used by the US Securities and Exchange Commission, or the SEC. It's also the default accounting standard but used by US public companies. That means that the numbers follow strict accounting rules. Meanwhile, non-GAAP means that the values were adjusted based on management's judgment. Plus, analysts are expecting next quarter's bottom line to improve significantly year over year. However, the data center revenue was weaker than expected. It rose only 3% from the last quarter. Data centers, well, they've become the largest and fastest growing business for many in the tech industry. So seeing Marvell's slow growth in that department is a bit of a cause for concern, right? That 3% might not sound terrible for other companies, but in AI, where everyone's racing, standing still can feel a little bit like falling behind. Now, Marvell's guidance for Q3 has also dampened investor enthusiasm. Management is calling for the same 2.06 billion in revenue plus or minus 5%. So flat guidance, that's Wall Street's version of a shrug, and investors hate uncertainty. Now, jumping over to the balance sheet, we can see here that Marvell finished the quarter with over 4 billion in current assets. Meanwhile, current liabilities sit around 2.4 billion. That means the company has more than enough money to cover their short-term obligations, actually nearly twice over. So Marvell's short-term liquidity is strong. They have plenty of cash to handle their day-to-day operations. Meanwhile, long-term debt is flat year over year, suggesting fiscal discipline. And that means management isn't taking any big risks and over-leveraging despite its ongoing expansion efforts. But Marvell did issue some senior notes in June, due in 2030 and 2035. And if you're unfamiliar, senior notes are the type of debt issued by a company to raise money. Think of them as treasury bills or IOUs. The big difference here is that senior notes take priority over any other type of debt. That means that if Marvell goes belly up before the debt is due, senior note holders will get paid first before anybody else. It's basically the safest IOU the company can issue, but it also adds future pressure to pay it back. In its cash flow statement, the senior notes are reflected in the debt issue line item right here. So that means Marvell now has more cash to spend, but these senior notes reflect added future cash outflow. And I've learned that when a company starts borrowing during an expansion, it's not always a red flag, but it can also be a test of discipline. Marvell is going to need to maintain a good balance between growth and investing and debt management to keep this train going. Now, I'm going to be covering Marvell's third quarter financials as soon as they get released. So definitely watch out for it because those numbers could really begin to make or break investor confidence in 2025. And I'm going to be watching every single line. Now, with all that out of the way, is Marvell stock a buy right now or ahead of earnings? A consensus among 34 analysts, they think so, rating Marvell as a moderate buy with an average rating of 4.38. Analysts also have a high target price of $122, which suggests about 38% potential upside. As far as Wall Street ratings go, Marvell looks like a solid pick, though volatility is to be expected. So I think you could say that the market's torn. Short-term fear, long-term potential. And that's where opportunity often hides. Now, before I go, I have one last question for you. Do you believe in what Marvell is doing? Let me know in the comments below. And while you're there, don't forget to hit those like and subscribe buttons because it'll help others find the video, it'll support the channel, and you won't miss out on any of my future deep dives. Well, folks, that's it for me today. Thank you so much for watching, and I'll see you next time.